Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Becca Hint. She began her career in real estate by house hacking a duplex in San Francisco and then purchased a 12-unit apartment complex. And now she's an investor in over 500 units and lives with her family in Costa Rica. So thank you so much for being on the show, Becca.
My pleasure, Charles. Thank you for having me.
So give us a little bit of your background, both personally and professionally, prior to getting involved in real estate investing.
Oh, you bet. Well, I'm from the Bay Area, and my husband and I were in medical device sales for the last 20 years or so. We would sell those large machines, the CT and MRI scanners. So great jobs, big paychecks, big income, big territory. It was... I realized pretty early on, the more money I made, the more taxes I would pay.
Especially in California.
Especially in California. It was a tax massacre. So pretty early on, I said, oh my gosh, I better get myself a tax deduction and a place to live. First, those two. And I was single at the time, so I bought this duplex in San Francisco. And I lived in the upper unit and renovated the downstairs unit and then flip-flopped. It was only myself and a contractor that bid on it. So that was just not a good idea. I just thought my parents said this is going to end really poorly. But it worked out. It was a major lift of a project. And I had to prop up the building and put a garage underneath. And you get to charge another $500 in rent in San Francisco for that. So did massive renovations, structural things. I mean, so much for a first property. It was great. Glad I did it. I'd never do it again. But what it provided me was the insight into passive income. And I was realizing I'm getting mailbox money. I'm getting a huge tax deduction. I need more of these. So my love for passive income began then when I had that property and I was still in my medical device job. So then it became, how can I transition more into real estate and get more mailbox money?
Oh, that's great. So when you were starting out in real estate afterwards, where did you transition? You weren't obviously doing other house hack, but you went into commercial multifamily. Is that correct?
Well, I thought, okay, I got to scale this a little bit and I need to go outside of California because things are so expensive in California. So I did two things. One, I started investing passively. I invested into 149 unit in Longview, Texas, which was a great experience. And actually it didn't go that well. That's why it was a good experience. I learned a lot, but it's good to be on the sidelines and watch what other people do and what they do wrong. And then meanwhile, I bought a 12 unit in Kansas City. Was sort of these deals, it was one block away from a good area. The path of progress was heading that way, but one block. So it was a bit of a speculation play. Lesson learned, though, that path of progress needs to happen within your hold time. It happened, but it happened 10 years later. And I only held it for 3. But, lots learned there. I call that kind of my training ground. And the big takeaway there was that unit size just wasn't large enough to sustain a steady cash flow. Because if you had one tenant or two tenants even that move out, it's blown your cash flow for 6 months. It was good while it was good, and everybody was there and it was occupied, and it was underwritten for 10% vacancy. But once it dipped below that, I was in a negative cash flow position, and I realized I just wasn't large enough. I needed to scale, and I needed to find efficiencies, economies of scale, which I had determined it happens at about 50 units and up. The one good thing about that deal, though, is I used to be in the RE Mentor program many years ago, the Dave Lindahl. I've since been more in the Michael Blanc group, but I'd like to be in these mentor groups just to have other minds around me. And that RE Mentor group, 15 years ago, they were preaching emerging markets. And they're absolutely right. And this is what saved me. As long as you're investing in a rising tide, all boats rise in a rising tide, and you can make a lot of mistakes and still make money. Yeah. So on that Kansas City deal, with all of my mistakes, like I could write a whole book on everything done wrong there, but still I came out selling that building 20% over what I bought it for only 3 years later. And absolutely not because of my brilliance, just because of a rising market. So from there, I said, okay, I'm going to take a snippet of this and make sure I'm investing in markets that have an increase in population, diversity of income, and that I can buy at a good unit cost, and all the other metrics work out in that. And it wasn't San Francisco anymore, of course.
That's great. Yeah, when you're in an area where you have job growth, population growth, decreasing crime, so you're in a growing area, you have the ability of not being completely perfect with your estimates. And that gives you the buffer, like you said. It's very, very important, because if you're going into an area that's just cash flowing, or you see a steady population or even a decline, you have to be very careful with what you're doing. And you really have to really steal the property, because there will be things that pop up, and you're not going to be able to, if you're $50 off on your rent targets in a growing area, maybe it's another year and you can get those. In a stagnant area, it's going to take you years, and that's going to push out that. So that's awesome. Great information there. So tell us about kind of your journey from medical sales. You've already started investing and now becoming a full-time real estate investor, which I feel most people that want to be active in real estate, that's kind of their goal.
You bet. Well, I guess as a traveler, I just have a sense of wanderlust anyway. So it was imperative for me to figure out something that I could have a location independence, and that I wasn't committed to a W-2 job going into the office every day. And for every road pointed to real estate in that for me. So what I did is I continued to invest passively, to watch how other operators manage their assets, learned a lot along the way, and then began to run my own deals in active. And I straddle both active and passive investing. I'm a big passive investor, probably 60% passive in of my holdings. But Charles, the main goal became, how could I live overseas? I was a backpacker in college all through Europe, and then I spent 6 months traveling around the world, going to see China before it became part of communist, or going to see Hong Kong before it became part of communist China. Did the Mongolian merchant train through Mongolia and Russia, and it's just an intrinsic need to travel. So I said, how can I still make money and pursue my love of travel? And then real estate, as I said, became the way. And it ended up where we are now, which is Costa Rica.
That's awesome. That's fantastic. And how long have you guys been down in Costa Rica? You and your family?
I hope you just heard the howler monkey there, because that wasn't me growling at you. But we've been in Costa Rica since August. So my husband and I, during the pandemic, things just became so difficult in California. We decided to pick up our two kids, age 11 and 12, and rented out our house, stitched together all our passive income, and moved last August. And we moved to We're in Nosara, Costa Rica, which is on the Pacific side. And it's one of the blue zones of the world. I don't know if are you familiar with those at all?
Yeah, there's a few of them. Japan, Sardinia, Italy. There's a few other. My brother's been pushing me to buy a house in Sardinia, Italy for years, and he's pushing this blue zone. So I've looked into it. Yeah. So.
Oh, you should. You should. They're amazing places. But for your listeners that don't know about it, there's about 6 of them in the world. Sardinia is one of them. Costa Rica, Guanacaste province, where I am, Okinawa, Japan. And these are places where people live to a very old age. So there's the highest concentration of centenarians, and it's because of their lifestyle and the things they eat, the things they do. So it's a very health and wellness. We're in a boutique surf and yoga hub here. So it's been a huge life upgrade for our family. And our children, they attend an international baccalaureate school in between the jungle and the sea and surf several times a week. So it's been amazing. And real estate has been the way to do this. I could have never done this in my med device job.
Wow. Yeah, every time I talk to people on med device, they say it pays really well, but the day they start, they are looking to the day that they can quit. So I don't know how true that is. Yeah.
But yeah, that's very true.
So tell us about right now, you're 60% passive, 40% active, and getting into one of these active deals in a second, but kind of give us an idea of what your current investment strategy is. Like, what are you looking to invest in both actively, and what are you looking at when you're passively investing? Like, where are you right now with that?
You bet. Actively, we're actively and passively. I'm multifamily, and my model is a co-GP model. So I am in contact with lots of sponsors, and we bring our money into their deal, and we're side by side as a general partner. They are boots on the ground. We look for growth markets, Arizona, Texas. We love Texas. We're looking more into the Southeast now. We like Florida. We like Georgia. And we look for light value adds. We're looking at A and B properties now. We've moved a bit away from the C. So that's essentially 1980s and up, light value add deals in emerging markets.
Interesting.
And we like to be out in about the 3 to 5 year timeline.
May I ask why you're avoiding C-class? Because it's something that we've been doing here over the last 2 years.
Yeah. Yes, I know. And we were in C-class for quite a while. And we still kind of dabble in them. We look at them, but the feedback from other investors that we have found, and even our experience, is they look really good on paper. But as I experienced with my Kansas City building, the management of this class of tenants is very labor intensive. It wears out the property manager. It exhausts us. You have move outs in the middle of the night. And it's just very labor intensive. And with cap rates so compressed that we're finding we might as well be investing in B properties. Also, there's less repairs because the buildings are not 60s and 70s, they're 80s. But saying that, these deals are hard to find. There's way more C-class buildings, and in looking for value adds, there's greater value adds in Cs. But we are finding some good A-class deals, actually, more like A- properties that were bought from the builder. And they just filled up the units with, anybody they could just to sell it off because they're not in the leasing and property management business. So we've been able to find, $100, $200 rent bumps in some of these A-class buildings. The downside is they're pretty expensive to buy. So this is a team sport, as you know. So it just requires a bigger team to take these down.
But you might have there at that point, you might have more investors, larger, more professional outfits that you're selling it to. That's where you're really getting an institutional buyer with those nicer properties, as I found.
Yes, agreed. And I'm also finding, just on the investor side, my investors prefer to see buildings like this. They kind of look at C-class buildings, go, oh, well, it's not so pretty.
Yeah.
But saying that, we still do dabble in Cs, but most of our focus is As and Bs, value add, emerging markets, multifamily.
Yeah, I find that the B class range is like one of the biggest ones because a B- is going to differ greatly from a B plus. And you're an A and you're like, well, there's not much difference between like an A and A. It's granite. You got granite everywhere,
Right.
marble or whatever. I mean, it's beautiful. What do you want me to say? So he doesn't have a big enough swimming pool for your Olympic laps. But so talk about this is really interesting. You're converting a motel to 65 apartments, and I guess it was a Comfort or Days Inn? I don't remember when I was doing research for this, but it's in Phoenix. And it's an interesting topic that we don't talk about much here. So explain this deal to us and how you got involved with it and everything.
Oh, you bet. These are fun deals. These are hotel to multifamily conversions for your audience in case they haven't heard about them. But these are a lot of fun and they're deep value add. I mean, heavy lifts. So buckle up, put on your patience cap. It's a long road. But it pays off in the end because you can get these deals at just a fraction of the price. We got this at 30 cents on the dollar, so a 70% discount. It's a 100-unit Quality Inn motel that we're taking down to 65 units of multifamily, so 31 one-bedrooms, 31 studios, and then the remainder 2 bedrooms because they were suites.
Nice. And tell us about so whenever I've spoken about this or spoken to contractors about it or other partners about it, the first pushback I get from contractors that have actually looked into these or done it is electrical. And
oh, yeah.
So what can you tell us about issues you've experienced? Because I mean, even if I'm renovating a C class or B class, electrical is not going to be a major thing unless it's like, 100-year-old property and I've got like knob and tube. But if something that's built in the last 40 years, electrical is really not a huge thing. Maybe it needs an upgrade on the service, but I'm usually not having to run lines on a property like this or kind of redoing the whole thing. So what issues have you experienced with this conversion that you did not expect or that you're normally issues that you don't see when you're renovating a typical apartment complex value add style?
You bet. There's a ton of them. And actually, electrical isn't even a big one in comparison to all the other problems you can have. But mostly with hotels, you want to think fire. So counterintuitively, many hotels don't have fire sprinklers because there's no kitchens. So when the city comes in, the first thing they're going to say is you're going to put kitchens in here. You need a new fire hydrant to enable a dedicated line for the fire sprinklers you're going to put all throughout the building. The cost to us was about $200,000 for the fire sprinklers alone. Also, the sheetrock, because of fire, sheetrock in motels aren't as thick as sheetrock in apartment buildings. Maybe that's why they're always so noisy. But you need to often redo all the sheetrock because it has to be fire safe. Then back on the fire theme, you have your windows. You have to have egress on your windows. So if you have a second story hotel, then like we did, you have these floor to ceiling windows that are beautiful, but you can't get out of them because hotels think of suicide risk for windows. They don't think fire egress. So we've had to take out these huge windows, reframe them into smaller windows that can open for egress. So big things on the fire side of it. Yes, electrical's sometimes an issue. It depends on the building and the age. So that's another one. Doors are actually kind of fun too. You end up with all of these funny doors, because we took out, we're going from 100 to 65 units. So we had these really thick security doors that, you can't even kick them down like you have in hotel rooms. So you end up with we have a whole graveyard of doors. It's a merry-go-round of doors. Where are we going to put these? Should we put them in the bathroom door? Should we put them on the bedroom door? But so those are kind of fun. But yeah, lots of things in renovation, including electrical. Fire's a big theme. But before you'd even go into that, Charles, you'd go into the 3 things to consider that even if you even wanted to even do this, and it must start with zoning. In hotels, you need separate zoning usually. In our case, we're in a tertiary market of Arizona. So we had an over-the-counter permit, just a change of use for zoning. But in larger markets, we have a friend in Arizona in a much larger market there that the city said, okay, we'll rezone you from a multifamily to a hotel, but with strings attached. You need to put in 2 fire hydrants and repave the road to the tune of $500,000. So it's important to underwrite. And he underwrote for that. And it was still a shocking number, but that's something that you must start with that. Otherwise, you'll be in the hotel business, and that's what they're trying to get out of.
Right.
Also, things to consider is the franchise cost. You'll need to buy yourself out of that Quality Inn franchise or whatever franchise brand you're buying. That can range anywhere from $35,000 to, $250,000 and potentially more, depending how big the brand is.
Interesting. Yeah, whatever that flag is, you're going to have to pay for it. I've heard all different types of fees like that because of depending on what I've seen is different, let's say different levels of the hotels, right? Different flags that they have. Some of the more expensive, more luxurious ones might make it a little harder for you compared to the, Comfort Inn that you're working with. So that's quite interesting. How long have you been working on that? And how long do you think the whole process will take?
We are, we're about 18 months in now. And we're just getting the occupancy permits for phase one. And this is another wacky thing when you deal with the city. They say one thing and then they do another. And large projects, you just need to brace yourself for that. So we got our, we did phase one. We had all the floors and paints just put in a couple of weeks ago, applied for occupancy. And they said, hey, this is great. We love it. You guys will give you occupancy for phase one. But you know what? We want you to do all the fire stuff in phase two. And we said, well, but we're not opening that side of the building. Why do we need to do that? And they said, well, we don't know. We just changed our mind. So go ahead and do that and we'll be back. So we're just finishing up phase two fire so we can open phase one. But yeah, they're heavy lifts. This project in particular is a legacy deal, which is a lot of fun. It's true mailbox money in the end. And this is structured that at about the about 2.5 year mark, we'll do a refi and give investors a large chunk of their money back. And then at about the 5.5 year mark, they'll get the remainder of the money back. And then we hold the property for 10 years, just mailbox money, infinite return for the investors. And I love this because it's true mailbox money in that sense that I don't want to be always looking for deals and essentially flipping multifamily buildings for the rest of my life. I'm looking for a longer term cash flow play to subsidize my life overseas. So we love that. And all the while getting, tax deductions and cash flow. And you can do this with hotels because you're buying so inexpensively. Typical syndications in multifamily, it's much harder to do a 10-year legacy play like this because there's just not enough meat on the bone to do this. Investors need their money back. And then once you do that, there's, often not enough money to support the deal later on after a refi. And then even a second refi, you can't really do that. But if you buy something for 30 cents on the dollar, you can sure do that.
It sounds more like a new construction, new development type passive investor mindset you need to have. Where you're not getting $1 for 2.5, 3 years. And then after that, then we can refinance out and probably multi-stage how you're doing it and really get the thing rented. And are we selling it or are we refinancing it? Which will really matter too, I guess, how long you're holding it by where the market is at that point too.
Yes.
And, the whole thing. So
you've got it right. And your investors need to be prepared for that too. That everybody knows this isn't a cash flow play from day one. It's not even a cash flow play from day, month 18. It's a bit farther out. And they know that, but they know that there's a bigger chunk on the back end.
Yeah,
and
there's a lot of value. Yeah. And if it was easier, everybody else would be doing it. And getting into something like this, I mean, it seems like quite the undertaking. But interesting, very interesting. So tell us about, I kind of like you're living in Costa Rica, which is great. I mean, how do you operate your business remotely? Obviously, you have partners, as you mentioned, that are boots on the ground. Now, do you have assistants that you work with for working on your part of the business or any employees that are underneath you? Or how does that work? How are you structured?
It's my partners and I am structured on a co-GP model. And apologize, the little prop planes going over here in the jungle. It's like Jurassic Park. So it's the one plane a day. So it's a co-GP model and I partner with experienced operators. It's my team and I. So we have our underwriter and we have our, I'm more like investors relations that I'm finding the deals, finding the partners as well. And then just for my basic business, I have VAs that help me with just administrative type of things. but it certainly can be done overseas without any problem. I mean, realistically, we hadn't left our house in the last 2 years. Yeah. Back in the Bay Area. So that just, that proved it right there for us. And that was one of the impetus of this. I said, honey, we should just take this game overseas because I said, hey, do you know how much this house cost in the Bay Area per day? And look how much we could rent it out for Airbnb per day. And then look how much we could live in Costa Rica per day. And we could live off that delta in addition to stitching together other investments of ours, like our San Francisco building and these passive deals and, a bunch of other things we just stitched together and said we could do this business completely overseas and live a much more tranquil life than the madness of the Bay Area during the pandemic.
So how difficult was it for you and your family to relocate to Costa Rica and in your business as well? And what kind of problems have you faced during this process, I guess? Because I imagine there's other people too that would love to kind of mimic what you guys are doing.
Oh, yeah. Well, it starts with really, getting rid of things is where we had to begin. I think most Americans have this problem. Yes. We were on the quest for minimalism actually quite a bit before this, but we were surprised at still how much we had. So it took about 6 months to just get rid of things on Craigslist, on Nextdoor, putting it out on the curb for free. Then we said, okay, do we want to, rent a storage shed or, and those get pretty expensive. And I thought maybe we should invest in a storage unit actually, but a storage center, but seeing the multifamily and storage business we're in. But what we ultimately decided is we bought one of those tough sheds. We bought the largest one we could that didn't require a permit. And we put every single thing in the backyard. And we determined the break even on that was like, I think at the 5 or 6 month mark versus buying or just putting everything in storage, which was a much better idea anyway. That way we could be gone for as long as we would ever like to be. So there was that. There was the getting rid of things. But for your audience, I would say it would start with, hey, where do you want to go? Most people do have an idea of where they want to go. And then determine your current living situation. Do you own a house? And if so, can you rent that out? How much can you rent it for? Is it better to do an Airbnb depending on the time that you're going to stay? Or is it better for a long-term rental? For us, it was better a long-term rental and just put everything in a storage shed in the backyard. And then determine the cost of living, where you want to go. I have a guide that we'll go into that actually has a cost of living calculator for that. But if you have kids, back up. It has to start with that because don't do like I did, which I said, great, we're going to leave it all behind and live in a grass hut on the beach in Costa Rica. Oh, wait a minute. I have 2 kids and they need to go to school. And I'm sure not going to homeschool them because that's what we're trying to get away from in the Bay Area. So I said, okay, we got to back it up and start with the school. So we started with the very quality, good, high quality school, and then determined our place from there. But
that's great.
It's a lot easier than you think, I would say to your listeners. There's something that's known as the expat journey, in which the first 3 to 6 months are kind of hard. You're trying to figure out where everything is. You're meeting new people. You're finding your expat crew. You're trying to integrate with the locals, getting the language down. It's a little bit tiring at first, but it's about at, beyond 3 months, or for some beyond 6 months, then it's much easier. And you'll be so thankful you did leave it all behind.
Yeah, it's also an interesting too, like you said, the cost of living. I know that you offer it in your guide, but it's, if you ever look on that, between even areas that are pretty popular, you'd say, like parts of Europe and stuff like that, you look at it and you're like, oh, well, this is the same price as home, but this is much less expensive. So it's very interesting if you're ever burning time and want to kind of see how that goes. It's very, I've looked at that before and it's like, wow, I never knew it was that inexpensive when you rent an apartment for 12 months or rent a house for 12 months, not 12 days. So yeah. It's definitely different.
It's definitely different. And then, something else to think about is how much can you live very well in another country for, like you just said, but your primary residence becomes a tax deduction. So your trips back home become tax deductible to a certain percentage to visit your asset, which is your primary residence. And meanwhile, visiting family and everything else. Then the process of getting your home ready to rent, all those things are deducted off up to about a year ahead of time. So you need a new kitchen, new bathroom to make your home rent ready. All those things are tax deductible. So ladies, want a new kitchen, new bathroom? Here's your ticket.
No, that's fantastic. There's always different ways of working around it. So if there's a will, there's a way, right? With what you're working on.
There's a will, there's a way. That's it. And people think of a lot of reasons why they can't do this. Everybody says, oh, I want to leave it all behind, some point in their life and move to a tropical island, but they list all the reasons that they can't. And I'm here to tell you there's plenty of reasons and ways you can do this if you want it bad enough. It's just how bad you want it and what's your sense of why. And the best sense of what the people that have the best sense of why are those that the why is outside of yourself. And for me, it was for my children to learn Spanish also, in addition to leaving the madness of the Bay Area. But I've been on this quest since they were very little, and it was imperative that they live in a foreign country at a certain point in their life to be immersed in Spanish.
Interesting. How long do you guys think you're going to stay there in Costa Rica? And what's next? Or are you there for extended period of time?
We are going to be here as long as possible. So we shall see where this journey takes us. I had eyes on Europe. I was actually hoping for Europe during this pandemic, but Europe wasn't doing much better than the US. So we decided for the tropical beach town that was a little bit safer. But as long as possible is my answer right now.
That's great. So coming to a conclusion here with our show, I just want to kind of get some questions that I ask all of our guests. And one of them being, what are common mistakes you see other real estate investors make during all of your career in real estate investing?
I would say a common mistake is underestimating the looking at cash flows. Many people look at the numbers and say, okay, great. We got this. This is a cash flow play, but they overestimate how much that they can get for rents. So they'll budget the rents at the highest point in the market based on the comparables. Too aggressive performers that are too aggressive, buying at a point in the market that it's saturated, too high of a unit cost, not buying on the path of progress in an emerging market, not buying units large enough for an economies of scale. 50 units and up, in my opinion. Some people will say 40, but at least 50. And then for your first couple deals, it's often buying properties that are advertised as maybe C's, but are maybe C minuses, just, right on the border of maybe not good areas, because they look enticing when you're doing the numbers and you're underwriting 200 deals. Then you finally find one. And then you're happy the numbers work, but oftentimes when you really check the areas. Also, I would say not investing with experienced operators. And that's what my business model, as yours is as well, in that we vet these deals. We are investing ourselves side by side with our investors, and we are partnered with experienced operators. This is a game that you bet on the jockey, not the horse. So you need to know who those people are. And I know the other side of it because my first passive deal just actually went up in smoke. The numbers looked good, but operators weren't experienced enough. Knowing what I know now, I absolutely vet the operators, then the area, then the deal.
Yeah, so, that's fantastic. It's always important
I started with the deal. And my mistakes in my first limited deal partnership, I started with the deal and then the area and then the operators. And it should be exactly opposite. Operators, area, deal.
It's funny.
Sorry to talk over you.
No, it's fine. It's fine. We have a touch of a delay. What I was saying is that what I find from the wealthiest investors that we work with, more sophisticated, let's just say, is that they are working just how you said. It's on the syndicator and then the operator, and then working down the line from there and coming to, the deal, property manager. They're going all down the line, but it starts with the operator because that's going to make or break it, and the resourcefulness of that operator as well. So there's a lot of different factors to it, but I've seen it much different between people that are sophisticated and people that might be new investors, and they go more for deal, sophisticated much more for the operator, and know more about you and what your team is experienced first. So interesting.
Yeah, that's exactly right. Which is the tremendous value of your services and my services, is that we know these people, because there's plenty of people out there, like I was in med device and all my other physician friends, that they say, I don't even have time for that. I don't know who's a good operator. I'm not going to go to these meetings. Just find them for me. And that's what we do. So
what do you think are the main factors that have contributed to your success over the years?
I think trial and error. I'm sure there's another way. I've gotten all the education I could continue to get. I mean, you can always, there's always more, but I've been in 2 coaching programs thinking, okay, I'm going to find some magic bullet, something I haven't seen before or done before, and let me spend more money. But realistically, you just need to get out there and see for yourself. For those just starting out and for younger people, it's good to house hack. You'll learn a lot from house hacking. Then moving up into, maybe limited partnerships, I would say. I might just skip that kind of 12-unit experience really for many. But it is, it's just experience really in the whole thing. And even as a passive investor, just sitting on the sidelines, you'll learn a lot.
House hacking is great. I probably wouldn't suggest anybody to get into the size or the one you got into initially with what you're doing. That's a red flag when you and the contractor are the only ones trying to bid for it. But I got into my first house hack, and it was nothing as much as yours, in depth as yours, but it was an experience, and it took like a year or so. I was very young when I did it, so it took like a year or two to do it 100%. But I was able to get renters in 90 days or 60 days or something. But it was something. It was something. And second one, I knew a lot more about it. My second investment property, but it's just the first one. I still have scars from that I can revisit and know. We learned about this, Charles. What are we doing? So, but
I'm right there with you. I'm right there with you. There's a podcast I was on. I invited on. It's the real estate unsuccess stories. I thought, oh no, I don't think I should be flattered by this. But hey, maybe we'll go on together, Charles. Right? You want to do a duo?
So how can our listeners learn more about you and your business, Becca?
Okay, well, you could find me at hintinvestments.com. That's investments with an S. I have a free guide for your listeners. In fact, it's called 6 Steps to Put Your Income on Autopilot and Move Overseas, which is just a fun, easy read, free guide. And it goes over exactly how to do this. So it will have some good resources in there for cost of living index that I mentioned earlier to determine where you'd like to live. There's also the best places to live in 2022 for expats, which is an excellent resource. It also goes into how to do this. How can you stitch different things together? Look at your stock account that's maybe not loving you back, especially right now. And time to move some of those things into passive income. Look at your retirement. It talks about how to actually invest with your retirement funds. So that's a great place to start. And that could be found at www.hintinvestments.com, or you could reach out to me directly at Becca@hintinvestments.com. I'm also on LinkedIn. You could see Becca Hintergardt or Becca Hint. My Hintergardt's very long married last name that no one can spell, so Hint's a lot easier.
Great. Well, I will put those links into the show notes. Thank you so much for coming on today. And looking forward to meeting with you face-to-face at some point here in the near future.
Oh, me too, Charles. Thanks so much. This has been fun, and it's a delight to be on here with another multifamily investor and international traveler. We're definitely a whole tribe amongst ourselves. So it's been a pleasure.
Thanks again.
Pura vida, as they say in Costa Rica. Pura vida, pure life.
Great. That was awesome. Thank you very much. So I will Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.